There's one uncomfortable question most founders avoid thinking about. What happens if the one person holding the company together suddenly isn't around? The person who signs the big deals, the one investors trust, the one whose name is literally in the pitch deck. For a lot of startups and SMEs in India, the business and one individual are deeply intertwined. And that's exactly where something called a Keyman Insurance Policy comes into the picture. Hello folks, I'm Shashank, you're watching Ditto Insurance. At Ditto, we help you compare health and term insurance plans with honest, no spam approach. There is no forceful selling and no upselling, just IDI certified advisors helping you understand what fits your situation completely free. If you ever want a second opinion on your personal insurance setup, there's a link in the description to book your free call. Now, let's get back to the topic. Look, a Keyman Insurance Policy, also called as a key person insurance, is a life insurance policy taken by a company on the life of a critical employee whose sudden death could materially impact the business. Now, the company is the policyholder, the company pays a premium, and if the insured person passes away during the term, the payout goes to the company and not to the family. Okay, did you get that? And that right there is important because many people confuse Keyman insurance with group life insurance. They are not the same thing. In group life insurance, the employer buys a blanket cover for all employees as a benefit. Now, if an employee dies, the payout goes to the employee's nominee or family. But in Keyman insurance, the company buys a policy on a specific critical individual. Now, only if that person dies, the payout goes to the company. The objective is business protection and not employee welfare. Completely different purposes here. Now, legally speaking, the concept of Keyman insurance in India is defined under Section 10D of the Income Tax Act, not directly by IDI. It refers to a life insurance policy taken by a business on the life of an employee or someone connected to the business. IDI regulates how insurers issue such policies, but the tax definition governs its treatment. So, who qualifies as a Keyman? Founders, co-founders, CEOs, CFOs, senior sales leaders generating major revenue, technical heads whose knowledge is irreplaceable, anyone whose sudden loss could materially reduce revenue, disrupt operations, impact loan covenants, or shake investor confidence. Now, if one person's absence can destabilize the company, that person qualifies. Now, let's talk about why businesses even buy this. The payout can help absorb revenue loss, repay business loans linked to that individual, fund hiring and training of replacements, stabilize valuation, and reassure investors and lenders that continuity planning exists. Now, for startups and SMEs, especially where leadership concentration risk is quite high, this can be a critical risk management tool. Now, here is something that many employees actually don't realize. If you are covered under a Keyman insurance policy, great. It counts towards your total life insurance exposure. When you apply for a personal term plan, insurers will factor this in as well. If the Keyman cover is large, your personal coverage eligibility may reduce. And yes, you must disclose it during underwriting. Now, heading to the eligibility and structuring. The insured must be genuinely critical to the business. Consent is mandatory and this is not a formality. The insured individual must fully understand that the company is the beneficiary and must legally agree to the policy. This is both an ethical and legal requirement. Insurers also evaluate financial health carefully. Loss-making companies are often declined. Some insurers may also set minimum gross profit margin requirements. They don't just look at turnover, they assess quite a lot of things like profitability and margins to ensure the business has a legitimate insurable interest. Now, there are also shareholding restrictions. Individual shareholding often cannot exceed around 51%, and combined family holdings may have limits. The idea is to prevent misuse of Keyman policies for personal wealth transfer. The sum assured is not arbitrary. It is typically capped at the lower of a multiple of average gross profit over the last 3 years, a multiple of average net profit, or a multiple of the key person's annual compensation. The coverage must reflect realistic business risk and not unwanted huge numbers. Now, let's talk about the product structure itself. Keyman policies are typically issued only as pure term insurance plans. Riders like critical illness benefits or accident death benefits are usually not available under Keyman structuring. This is meant to be straightforward risk cover for death, not a bundled benefit product. Policy term usually aligns with how long the individual is expected to remain critical to the company, typically ranging from 5 to 20 years depending on the business plans and growth projections. Now, let's move on to documentation because this is not a retail underwriting. Here, you will need a Keyman questionnaire explaining the individual's role and business impact. memorandums and articles of association, certificate of incorporation, board resolution approving the purchase, company PAN and KYC, last 3 years, audited financials, and importantly, beneficial ownership declarations. These are required to meet anti-money laundering regulations and to identify who ultimately controls or benefits from the company. Insurers are required to verify this before issuing high-value corporate covers. This is structured corporate underwriting, not a casual purchase. Okay, now let's address tax. Premiums paid by the company are generally deductible as business expenses under Section 37(1). However, if the company receives the death benefit, it is taxed as business income. If the policy is later assigned to the employee, tax implications arise there as well. Now, as per CBDT clarifications, proceeds from a Keyman policy remain taxable and do not automatically become tax-free insurance money, which means always involve a chartered accountant before structuring assignment decisions. Okay, now one more very important clarification. A Keyman policy protects the company, it does not protect the employer's family, as I mentioned. So if you're a founder or a CXO covered under Keyman Insurance, you still need your own personal term insurance policy for your dependents. Now, this is not optional, it's a separate protection. And if at this point you're a founder or an important person thinking, I don't even know how much personal cover I should have alongside corporate coverage, then this is a good time to pause, head to the link in the description and book your free call using the link. Now, we'll help you think it through properly, we'll help you compare different plans, and we will never push you to buy through us. But we will give you clarity. That's guaranteed. Now, to wrap this up, Keyman Insurance is a strategic risk management tool primarily relevant for startups and SMEs where leadership concentration risk is high. It protects business continuity, supports financial stability, and reassures stakeholders. It is structured carefully, issued only as term insurance subject to financial scrutiny, and comes with specific tax treatment. It is not employee benefit insurance. It is not a substitute for personal life cover, and it must be structured thoughtfully. If you found this breakdown helpful and want help structuring your personal term insurance correctly, book a free call via the link in the description and we'll always be happy to help. And folks, I'll see you in the next one. Until then, happy insurance hunting.